Section 3.3 Understanding Dividend Payout Ratio, Dividend Policy and Corporate Objectives. A company's dividend policy and strategic objectives are key factors that shape its dividend payout ratio. The dividend payout ratio represents the proportion of earnings that a company chooses to distribute to shareholders as dividends. Here's how a company's dividend policy and strategic objectives can influence the dividend payout ratio. Dividend policy. A company's dividend policy is a set of guidelines or principles that govern its approach to dividend payments. It outlines how the company determines the amount and frequency of dividends. Different types of dividend policies include stable dividend policy. Companies with a stable dividend policy aim to provide a consistent dividend payout to shareholders over time. They strive to maintain a steady dividend payout ratio by distributing a fixed percentage of earnings or a predetermined amount per share. This policy is suitable for companies with stable cash flows and a commitment to providing regular income to shareholders. Growth-oriented dividend policy. Companies in growth industries or with significant investment opportunities may adopt a growth-oriented dividend policy. These companies prioritize reinvesting earnings back into the business to fund expansion, research and development, acquisitions, or other growth initiatives. As a result, they may have a lower dividend payout ratio as they retain a larger portion of earnings for reinvestment. Dividend smoothing. Some companies employ dividend smoothing, where they aim to maintain a relatively consistent dividend payout ratio despite fluctuations in earnings. This approach involves setting the dividend based on long-term trends in earnings rather than immediate earnings fluctuations. Dividend smoothing helps provide stability to shareholders and can result in a smoother dividend payout ratio. Strategic objectives. A company's strategic objectives and long-term goals significantly impact its dividend payout ratio. The decision to distribute earnings as dividends or retain them for other purposes depends on the company's strategic priorities. Here are a few scenarios. Growth and expansion. Companies focused on growth and expansion may allocate a lower dividend payout ratio to retain earnings for investment in new markets, product development, research, or acquisitions. They prioritize using earnings to fuel growth and increase shareholder value through capital appreciation rather than high dividend payments. Financial stability and debt reduction. Companies that aim to improve their financial stability or reduce debt may allocate a higher portion of earnings to dividends. By distributing a higher dividend payout ratio, they demonstrate their ability to generate consistent profits and repay debt obligations, which can enhance investor confidence. Cash preservation. In certain situations, such as economic uncertainties or industry downturns, companies may adopt a more conservative approach to dividend payouts. They may choose to retain a higher portion of earnings to preserve cash reserves for potential challenges or investment opportunities. This can result in a lower dividend payout ratio. Investor expectations. Companies consider investor expectations and market norms when determining their dividend payout ratio. They aim to strike a balance between satisfying shareholder expectations and meeting the company's financial objectives. Companies may adjust their dividend policies and payout ratios based on investor feedback. Industry standards, and the desire to attract and retain investors. It's important to note that a company's dividend policy and strategic objectives can evolve over time based on changing business conditions, financial performance, and market dynamics. Companies continuously assess their capital allocation priorities and dividend policies to align with their long-term goals and maximize shareholder value. In conclusion, a company's dividend policy and strategic objectives shape its dividend payout ratio. The chosen dividend policy, whether stable, growth-oriented, or smoothing, determines the level of dividend payout consistency. Strategic objectives, such as growth, financial stability, or cash preservation, influence the decision to distribute earnings as dividends or retain them for other purposes. By considering investor expectations and market norms, companies can ensure their dividend payout ratio reflects their commitment to shareholder returns and strategic priorities. Several factors can influence a company's dividend policy, including its growth plans, capital requirements, and debt levels. Let's explore each of these factors in more detail. Growth plans. Companies with ambitious growth plans may choose to reinvest a significant portion of their earnings back into the business to fund expansion initiatives. This can include investments in research and development, capital expenditures, acquisitions, or market penetration. When growth opportunities are abundant, companies may opt for a lower dividend payout ratio to retain earnings for reinvestment. By reinvesting in the business, they aim to generate higher future profits and increase shareholder value through capital appreciation. Capital requirements. The capital requirements of a company play a crucial role in shaping its dividend policy. Capital-intensive industries, such as manufacturing or infrastructure, often require substantial investments in fixed assets and ongoing maintenance. Companies operating in these industries may have higher capital requirements and need to allocate a significant portion of their earnings toward capital expenditures. As a result, they may adopt a lower dividend payout ratio to ensure sufficient funds are available for capital investment. Debt levels. Companies with high levels of debt may need to prioritize debt reduction and interest payments. In such cases, the company's dividend policy may be influenced by the need to maintain sufficient cash flow for debt servicing. A higher debt burden can restrict the funds available for dividend distributions, leading to a lower dividend payout ratio. Companies may choose to allocate a larger portion of their earnings toward debt reduction to improve their financial stability and reduce interest expenses. Profitability and cash flow. The profitability and cash flow generation of a company are significant factors in determining its dividend policy. Companies with consistent and strong profitability are better positioned to distribute higher dividends. Robust cash flow provides the necessary liquidity to support dividend payments. Companies with stable and predictable cash flow streams may have a higher dividend payout ratio, as they have confidence in their ability to generate sufficient cash to meet dividend obligations. Legal and regulatory requirements. Companies must also consider legal and regulatory requirements when determining their dividend policies. Different jurisdictions may have specific rules and regulations regarding dividend distributions. For example, some countries require companies to distribute a certain percentage of earnings as dividends or restrict dividend payments if a company's financial health falls below certain thresholds. Compliance with these requirements can influence the dividend payout ratio. Investor expectations and market norms also play a role in shaping a company's dividend policy. Companies strive to align their dividend policies with investor preferences and market standards to maintain investor confidence and attract new shareholders. If investors expect regular dividend payments, companies may adopt a more stable dividend policy with a higher payout ratio. Conversely, if investors prioritize growth and reinvestment, companies may opt for a lower dividend payout ratio to support their growth objectives. It's important to note that these factors are not mutually exclusive, and companies need to consider multiple factors when determining their dividend policy. The ultimate goal is to strike a balance between providing attractive returns to shareholders and ensuring the company's financial stability, growth prospects, and compliance with legal and regulatory requirements. Companies regularly assess these factors in light of their overall financial objectives and market conditions to make informed decisions regarding their dividend policies.